intercompany acquisitions, investments in other entities, and standard costs. 1. Intercompany acquisition. Understanding. Acquisition is the process of taking over a company by another company with the aim of controlling most of the company's shares or assets. It is usually done to expand market share, increase efficiency, or expand products and services. Type of acquisition. Horizontal. The company acquires other companies in the same industry. Vertical. Acquisition of a company in the supply chain, supplier or distributor. Conglomerate. Acquisition of a company from an unrelated industry. Acquisition accounting listing. In accounting, acquisitions are recorded by the acquisition method. The main steps. 2. Set the effective date of acquisition. 3. Assess all assets and liabilities of the acquired company at fair value. 4. Record goodwill if the purchase price exceeds the fair value of the net asset. 2. Investment in other entities. Types of investment. Ownership of less than 20%, usually considered to have no significant effect, recorded by the cost method or fair value. 20% to 50% ownership, considered to have significant influence, accounted for by the equity method. Ownership of more than 50%, considered a control. The financial statements are consolidated. Recording method. Cost method. The investment is recorded at the cost. Fair value method. If the market value changes, the change is recognized in the income statement or other comprehensive income. Equity method. The investor recognizes the profit/loss portion of the invested entity. 3. Standard costing. Standard costing. Understanding. Standard costs are costs set at the beginning as a reference for production. These costs are used to compare with actual costs as a basis for cost control. Purpose of use. Being a cost control tool of production. Assist in managerial performance appraisal. Provide an overview of operational efficiency. Standard cost component. Cost of raw materials. Direct labor costs. Factory overhead costs. Analysis of differences. Raw material difference compared between price and actual quantity versus standard. Labor difference compared between actual versus standard rates and working hours. Overhead difference can consist of differences in capacity, efficiency, and actual expenditure.